Hey, Steve Saretsky here. As always, it's the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you a thumbs up and subscribe. Questions, comments, put those below. I'll try to keep this video a little bit more concise this week. First off, there's obviously the groundbreaking report on money laundering. Obviously much talked about, much and speculated on here in Vancouver, but a recent report saying that there's believed to have been $1 billion laundered through Vancouver real estate in 2016. Obviously we're still waiting for a lot of the details on that, but basically revolves around the opioid crisis and gangs in China basically laundering money through Vancouver real estate. We know that would certainly have an impact. 2016 was really a year that, that was the huge leg up in the Vancouver real estate market. 2015, which really started with the outflows, large credit outflows out of China and into global real estate, and that happened throughout 2016. So that would certainly coincide with a lot of that credit coming into the market and inflating real estate prices. So again, this just really spurs on government to take further action. This is why it's just creating more political will for governments to bring in these what would normally be considered draconian policies, i.e. a foreign buyer's tax, a speculation tax. This really gives them the ammunition when you have these kind of stories come out that ultimately create this social angst of people who feel that they're really being cheated, hardworking people that are being trying to keep up with money laundering, etc. So I think it's a really important headline story that's obviously getting the attention of governments, and governments come in and regulate markets, and I think that's why we've had a lot of political backing behind these anti-foreigner policies. Whether you agree with them or not, this is certainly another case for them that we'll be keeping an eye on. I mean, if we look at foreign buyers, we can see that regardless of if the money laundering is happening or not, they have pulled back. If you look at, and this is not just happening in Vancouver, again, this is like a global phenomenon, as China's economy has been deleveraging, particularly in recent months. But if we look at foreign buying activity in the province of BC, per official BC government data, foreign buying year to date in residential property has accounted for $2.2 billion from January through to October. That's actually down to 28% year compared to the same period last year. So foreign buying, if you said $1 billion was laundered through Vancouver real estate, that would certainly be a huge number. Considering that year to date in the province of BC, we're at 2.2 billion. So maybe that comes in at 3 billion for the year. Again, that's down 28%. The official numbers say that foreign buying activity for residential technically only accounts for roughly about 3% of transactions, relatively unchanged from a year ago. But nonetheless, the volumes are down 28% year to date. Moving on into sort of another aspect of the market, but we do talk about those obviously credit flows, whether they're money flowing into a market, whether they are illicit or through the banking system, etc. Is in order for housing booms to formulate, you need large increases in credit, whether that be domestic credit or foreign credit coming into the market, and that's certainly what we've had. And I think a lot of people, it's interesting because we're at this aspect of the market here where we're seeing the stresses in the real estate market. I can tell you preliminary that November will be another rough month statistically for the Vancouver real estate market, which I'll do a video on next week. But you can see that the stress test, when you're reducing borrowing power at the same time you're cutting down on foreign capital coming in, it is putting stresses on the real estate market. And it's funny because there's so much evidence backed on the importance of credit flows to drive euphoric booms. And now that we have the stress test in place, all the industry groups are coming out against it, whether that's developers, mortgage brokers, realtors, etc. They're all against, they're all basically trying to lobby the government. The stress test is too punitive, it's hurting the market, and it's hurting millennials' ability to get into the housing market, etc. But at the same time, they're also preaching that we need more affordability, and one way, ironically, to get affordability is to limit the demand, which we can see in sales volumes. I mean, sales volumes in Vancouver are at, basically a 10-year low across the board. So, I mean, if you want lower home prices, you reduce the demand, the supply naturally increases and prices move down. And that's now what we're seeing across all property segments. But all of a sudden, now that prices are shifting down, everyone's saying, oh my gosh, this is out of control. We need to take off the stress test. Again, it's kind of counterintuitive. If you want affordable homes, you need to limit mortgage credit, and that's what we've seen. Mortgage credit growth is at an 18-year low, and of course now they want to reverse these policies. So it begs the question: do we even want affordable housing? It's interesting to look at it from, hey, this is hurting millennials. Well, it's like, do millennials want affordable housing, or do they just want to get into housing? You can't have your cake and eat it too. So there has to be a little bit of pain. I generally believe that free markets eventually work themselves out. Unfortunately, again, it's funny because everyone's saying, oh, don't remove this is so punitive, but we're again failing to acknowledge all the stimulus that we've had in the Canadian housing market really over the past 20 years, which has been a historic housing boom, which has basically largely been facilitated by CMHC securitizing over 80% of mortgages. So that's kind of where that's at. I think another thing that's interesting, we're seeing a lot of stuff coming out about the vacancy rates, and because of the new stress test, that this is going to ultimately reduce new construction because housing prices are starting to come down. So developers are going to cut back on new construction. Because the market is too uncertain, and because of that result, that the prices are going to continue to increase. And I've seen economists report on this, that it's because of record low unemployment, wage growth is going to continue, population is expected to continue to strengthen, etc. But as I've explained in many of these videos, and again, not just coming from myself, but I encourage you to download Ray Dalio's book on debt crises. I think if you go and Google Ray Dalio debt crises, it's a free PDF. All you have to do is read the first 50 pages. It's a 400-page book on debt crises. Dalio lays out the textbook on how these market cycles work, and this has been well researched by Steve Keen, Professor Richard Werner, and basically what happens is the large credit inflows, whether it be domestically or internationally, generally they are combined. They flow into an asset class that generally creates a real estate boom or a construction boom. The boom basically creates more and more job growth. More job growth creates the wage growth, which then creates increase of migration because people see a strong labor market. They come here looking for jobs, a lot of them temporary workers that ultimately funnel into the construction sector. And this creates a self-fulfilling feedback loop, right? That generates higher rents, higher housing prices, creating the wealth effect, people then spending money. But what people are failing to understand is the same thing as when a housing market then slows down, construction begins to slow down, wage growth begins to slow, unemployment begins to increase, and then the increases of migration then revert back into net out migrations. And this is like a textbook, a boom bust credit cycle. This is how these things work. So it's just funny because these economists are extrapolating the recent economic conditions and extrapolating them out. But the funny thing about economic, typical bank economists is in their models, if you actually understand them and look at them and study them, and this is something that Steve Keen has written a lot about, is none of them, not one of them, actually, when they make economic modeling, none of their models account for credit and money. Credit and money. They don't account for credit and money. That is like the economy moves on credit and money. So you would think like common sense, you'd be like, how do you guys not include that? But that's just how economics is taught in mainstream, at these schools. So it's a really interesting philosophy. So that's why a bank economist has really never predicted a recession, because they don't look at credit flows. I don't really want to ramble too much on that, but that brings me ultimately back to sort of where we are. Again, looking at sort of an economic structure when we talk about credit flows, something that we might be wanting to pay attention to. If you look at what's been happening, when I say people are so focused on Vancouver and not looking at this from a more wider lens, is that housing markets are not just slowing down in Vancouver. They're actually globally synchronized, which is a report that the IMF has discussed. And that largely has to do with what global central banks are doing, particularly with their money supply. So if you look, the monetary base right now is actually contracting. It actually went negative, and that's the first time it's done so since 2006. So what we've been used to is at the peak of quantitative easing, i.e. at the peak of central banks printing money essentially out of thin air, i.e. buying assets and suppressing interest rates and creating all this funny money. Quantitative easing hit an annualized $2 trillion. They basically printed $2 trillion at the peak of QE in 2016. And now it's down to $200 billion, with the central bank, particularly the U.S. Federal Reserve, basically reducing their balance sheet, reducing the number of assets they're purchasing. I believe they're rolling off something like $50 billion a month out of assets. So, you're removing basically the largest buyer of financial assets from the market. And so that's where you can see the monetary base now shrinking, and that obviously creates liquidity conditions. So, I think that's important to understand and keep into context. So I'm just trying to think if there's anything else that I have to add here, but those are pretty much the things that I've been watching this week. Next week, we'll do a full market update for the Vancouver real estate numbers for November. But again, that whole credit spiel is just my update on people talking about vacancy rates and rising rents and stuff, and it's blaming that the stress test is resulting in higher rent prices. Ultimately, rent prices are tied to unemployment and wage growth. In Vancouver, I think they had rents up 6% year over year. But I think in BC, wage growth was the highest nationwide. I think it was at 5.9%. So it's right in line with your wage growth. Something important to keep in mind. So anyways, hope that helped. Otherwise, see you next week.